I am Ben Reppond. Welcome to my YouTube broadcast. Today is Wednesday, July 12th, 2023. Let's begin analysis of the market, begin with the dashboards. The first dashboard is on, for this past week, represented in the yellow box, and year to date represented in the pink box. And you can see going down on the left side, the ETFs and the name of the indexes, beginning with the NASDAQ 100, the S&P, etc., all the way down to the bottom. And the last one is not a stock index, it's a bond index. It's TLT, which is the 20-year government bond index, considered the long bond. So for this past week, in the yellow box, you can see that all of the equity indexes had gains. Bonds, slight decrease. Year to date, all of them are positive, but in particular, you've got 2 that are very positive and 3 that are positive, and then it just begins to drop off after that. So the most positive is NASDAQ 100, the S&P 500, and the developed foreign markets, EFA. On the right side, you see the dots, and going across, it's the 20-day, 50, 100, and 200-day moving averages. Green dot, are they above the moving average? Red dot, are they below it? So that shows strength. So you can see that all of the equity indexes, nearly all of them, are showing a lot of strength. Bonds, in my opinion, are weak, and as indicated by the 3 dots. What's interesting about that is that, and we'll see it when I show you the bond index, is that this has an effect on traditional portfolios. I'll describe that more later. When we take the S&P 500 and we break it apart into its 11 sectors, all of these make up the S&P 500. So they start at the top with technology and consumer discretionary, all the way down to the bottom where there's healthcare and energy at the very bottom. These were literally turned upside down from last year. The worst this year was the best last year, and vice versa. We can see in the week was positive. You can see in the yellow box. The lowest gain for this past week was healthcare, up about 0.5%. The biggest gain this past week was real estate, which was up 5.23%, telecommunications up 5%, and energy up almost 5%. Year to date, there are 2 sectors in the pink box, 2 sectors that stand out significantly: technology and consumer discretionary, up 39%, up 31%. But that doesn't make up the S&P 500. It takes all of them. So then you start dropping down into industrials and basic materials and retail, etc. And then the last 5 are negative. So these are 5 sectors. These were the best sectors last year. 5 sectors that are negative year to date. So on December 31st, if you would say, what's in favor, you'd be looking opposite. You'd be looking at the red, those that are negative. And so anyone who was in those last year and stayed in them, they got hurt. And vice versa. Those that got hurt last year, they've done better this year. And then you can see, again, the 20, 50, 100, and 200-day moving averages. You can see how much of those are above. Nearly all of them are above all 4. So strength in the market, at least at this point, through last Friday. The S&P 500, you can see this is an 18-month period, and you can see the strength that it is going up, and represented by the black arrow. So well above its 20-period moving average. when we break the S&P 500 not into 11 parts, but into 2 parts, growth and value, the stocks fall into one of 2 categories, broad categories, growth or value. So I've got this set up so that the growth is the numerator, value is the denominator. So when it goes up, it favors growth. When it goes down, it favors value. So you can see this past week that, for the last couple of weeks actually, at the very far right of the chart, you can see it moving down. And what that means is that the value is become more in favor this past couple of weeks than growth. But generally speaking, since the beginning of the year, growth has been in favor and is still above its 20-period moving average. And we saw in March that large cap took off relative to small cap. Small cap declined. And so it really hasn't recovered much. So you can see from March to present, this is about 4 months, you can see that large cap, represented by SPY, is way outpacing small cap, represented by IWM, basically small companies. The long-term government bond, we talked about this earlier, TLT, is showing weakness. It has been showing weakness for about 7 months now, since December. And what's significant about this, and you can see where it's gone, you also can see the first part of the chart where it went last year, and it dropped about 30% last year. Bonds, supposed to be the safe haven, they have been for 40 years until they're not. And so why did bonds go down 30% last year, or the long-term bond go down 30%? Because interest rates went up. And interest rates went up a lot. And they kept going up more than people were expecting. And therefore, when a surprise hit, they kept going up. The price of those bonds, or the bond ETF, kept declining. And then it rallied a little bit in November. And since that time, generally speaking, it has been flat to negative. What's significant? Here's what's significant about this. Traditional portfolios, 60-40, 60 stocks, 40 bonds, buy and hold portfolios, don't touch it, set it and walk away, are being hit. They were hit hard last year. If you're in one, you know what I'm talking about. Stocks got hit hard. Bonds, in many cases, got hit harder. So bonds not only didn't protect stocks, they were a drag on stocks. What about this year? They're a drag on stocks again. Stocks have gone up, we saw that earlier, but if you're in a 60-40 portfolio, the bonds are putting a drag, government bonds are putting a drag on those portfolios, holding them down. So the growth is there because of the stocks, but it's anemic, which is why I don't believe in traditional 60-40 buy and hold portfolios. The dollar, US dollar, continues to decline. It began in October and generally speaking continues in a period of decline. Gold had a slight tick up, but it generally speaking in the last 7-8 months has been in an upward period of appreciation. Same with silver. Silver is more volatile. You can see the volatility in this versus stock. So it goes way up and way down more than gold does. But it is still in an upward trajectory, and its move up this past week was higher than gold. When I put those on a relative strength chart showing, how they are relative to each other, you can see it basically goes up and down a lot. Right now, there's not a clear direction, which is why I didn't put an arrow on there. But you can see this past week, And I think that's the last couple of weeks that silver is looking stronger than gold. Bitcoin has went into a little bit of a pullback. We exited our position in Bitcoin, or BITO, which is the ETF for Bitcoin. And so that portfolio is sitting in cash right now. But generally speaking, from the beginning of the year, it's had a nice period of increase. So the volatility index has been in a downward decline. What that means is that the market has gone up and is in a period of, generally speaking, stability for the last 8 months or so. And so here we see this past week where there is increased volatility starting to move up. We'll see where that goes from here, but I'd still say, generally speaking, we're in a period of stability for the market. Asbury Research has 6 metrics for their Asbury 6, and the one is negative, and that's volume. If you watched my video yesterday, done on Tuesday, I showed a chart that showed that the volume for the S&P is currently about 14% below its 50-day moving average, the average of the volume for that period of time. So no surprise that they picked this up as negative, because volume is anemic. There is not enthusiasm for going down or going up. The market is kind of treading water, I would say, right now. But the period that we've had of nice increases in the market are not there right now. That could return, but right now it's not present. Asbury goes on to show some relative asset relative performance, one asset versus another, relative strength basically. And so I'll go through these, the ones that get a green box for the weekly, monthly, and quarterly. So high beta, high volatility stocks, stronger than low volatility. The broad market, the S&P 500, is stronger than the blue chips, which is the Dow. Technology is stronger than the broad market, S&P. And growth is stronger than value. U.S. is stronger than developed markets. And then in the fixed income, high yield is stronger than high quality, and short term is stronger than long term. U.S. versus the world. The U.S. Is in a lot of these boxes, but there is no clear direction. They are like that much stronger than these other countries. And in some cases, this last week, a number of countries are stronger than the U.S. Many of these are developing countries, emerging countries. But again, the only one that is stronger than the U.S. by some degree, enough to get a green box, is India. Okay, gold and silver, precious metals. As of Friday, the spot price of gold was $19.32. That's up 0.3%. You saw that in my gold chart. It was a slight tick up. And silver, a bigger move up, $23.16 per ounce, and compared to the week before. The gold-silver ratio is 83-1, favoring silver. So gold being the numerator, gold being the numerator, silver being the denominator. So when gold is 83 times more expensive than silver, and when it's over 40-1, I consider that to be favoring silver being a better buy. A monster box, I get this information from my son Preston, and he's in that business, so he tells me what his prices are. A monster box of silver bullion is $12,715, down a bit. And that includes a $2.27 markup over spot. So that translates to $25.43 per round for 500 when you include the spot and the markup. And when you buy a tube of 20, it's $26.17. So they get a little bit more. They charge a little bit more for the smaller quantity, and that includes the silver, and it includes the markup. Okay, we've got rate hikes, and I guess it depends on which camp you're in as to how you see that. Thank you for watching, and if you have comments or questions, leave them in the comment section below. Thanks.